some background info. Traditional IRAs, Roth IRAs, and then conversions from traditional IRAs or similarly taxed vehicles to Roth IRAs. First, traditional IRAs, well, some distribution rules, taxes and penalties. You got this 59.5 rule. So if you take out money pre-59.5, there may be a 10% penalty associated onto it. There's certain ways to get around that, but that's a little bit beyond the scope of today's talk. You must pay taxes on earnings and deductible contributions as you take withdrawals from your IRA. So you get a deduction for putting it in there, or substitute 401k here, same thing. It goes in pre-tax. And when you pull it out, it's fully taxable, okay? Required minimum withdrawals or required distributions must begin prior to April 1st of the year after the year you turn 70.5. So this is, you have to start taking it out. If you don't take it out, there's a bit of a penalty. Anybody remember what that amount is? It's just 50%. 50%, yeah. I'd say Judge Learned Enhanced quote is certainly applies to this portion. So there's certain rules attached to these traditional IRAs, essentially. And most people accumulate their assets where? In traditional IRA, 401k at work, employer matching contributions, maybe profit sharing contributions, maybe a pension that is taken as a lump sum and rolled over into an IRA. Right. Most of our money is not yet taxed. And that's a great way to save and accumulate. But the thing you have to remember, there's kind of like a contingent liability on that. Part of that money is Uncle Sam's. He just hasn't gotten his money yet. Roth IRAs, on the other hand, you pay the tax. So you kind of pay the tax on the small amount, get it over and done with. It grows tax deferred. And then when it comes out tax-free. And essentially, and I do have some clients that are doing this, but they're continuing to work into their 70s, even if it's just part-time or a little bit, but you can't contribute to a traditional IRA after you turn 70.5, but you can contribute to a Roth IRA. So for anybody that kind of, even semi-retires or has, $6,000 of earned income, even in their 70s, can put $6,000 into a Roth IRA. If you have consulting income or something like that, if you kind of retire and transition and maybe stay attached to your former employer or consult with some former business people that you worked with, as long as you have earned income. Some of the advantages, again, tax deferral, tax-free withdrawals. There's certain 5-year strings that are attached to these, and they're different for contributions versus conversions. Tax planning flexibility. This is one of the biggest things. Since you don't have to take withdrawals by 70.5, you have more tax planning flexibility during retirement. And I would also kind of take that one step further and say, just like we want to have a very well-diversified portfolio, if we can convert some pre-tax money into tax-free money, and it's not really going to put us in a negative situation or anything, it's kind of a cheap insurance, if you will, against higher tax rates in the future. How many people fear the elimination of the income tax? What are you laughing at? How many fear an increase in the income tax? Yeah, and they're already talking about that. The question is, where is the line in the sand going to be drawn? How's that going to affect you? Are you going to be on below the line in the sand, or are you going to be caught above it, so on and so forth? If we can convert some dollars and really not put ourselves in any better or any worse position, I still say that makes sense for the simple reason of you're taking out kind of a no-cost insurance policy, if you will, against future tax rate increases. So the 2010 income limits for Roth IRAs, you can see here that they're different for married filing joint versus single. And this is based on something called adjusted gross income, but 167 for married filing joint. You can make your full 5,000 if you're under age 50, or as most people in the room, 6,000 if you're over age 50. And if you're a single filer for income under 105, you can make that full 5,000 or 6,000 contribution, depending on whether or not you're over age 50. Married filing separate, sorry, no luck there. They don't like you playing those games too much. An important note here, how many people at work have a Roth option in the retirement plan? A few, and they're becoming more and more common and more popular, I guess you could say, but there are no income restrictions on Roth options of work. And if you're over age 50, you can put as much as $22,000 into those plans. Now they could be, just like anything, it depends whether or not you want to take advantage of that, depending on what your tax rate is today versus when it's going to be when you retire. And we'll talk about that in a little bit more detail. Conversions. Now, conversions are different than contributions, and that should be the first thing there. So contribution is not the same thing as the conversions, even though it starts with the same letter. And there's different tax rules that apply to a contribution versus what applies to a conversion. Some convertible accounts, traditional IRAs, 401k plans, profit sharing plans, 403b annuities, tax sheltered annuities, just a 403b plan, 457 plans, so even Ohio deferred comp, which is a 457 plan, falls under this, and inherited 401k plan assets. So this is something that's new, but you can't do a conversion of an inherited Roth IRA. So there's a couple people that have inherited IRA accounts. Maybe you got them from your folks or from an aunt or uncle or something like that. And you have to take a minimum distribution each year. You can, if it's left in a 401k, you can convert that, but if it's in an IRA, you can't. Why the difference? Who knows? Probably an oversight. Some non-convertible accounts, inherited IRAs, again, and education IRAs are not convertible. So it is more than just an IRA, I guess you could say, is kind of the message here. Some examples. All right, now we're not going to go over all these assumptions in great detail, but I can tell you, being the geek with the personality that I like to think that I am, you always have to make some assumptions when you do this planning, and everybody's situation is different, but you kind of want to be as objective as possible when you kind of run these numbers. It's for some people, Roth IRA and Roth IRA conversion is a great idea. For others, it's not. So some of the assumptions that I thought were kind of held water, if you will. Let's assume 65, and we have a $100,000 regular IRA, and we have almost $30,000, $28,000 after-tax funds available. Okay, and we're going to convert $100,000 from the traditional IRA into a Roth IRA. 25% flat federal tax bracket on the minimum distributions from the regular IRA. And when do those start? Yeah, 70.5, or technically the year after the year you turn 70.5. 28% tax bracket for the conversion. So I'm actually saying here that we're actually going to increase the tax rate because the amounts that we're going to convert is going to bump our taxable income up into the 28% bracket. Is there a big difference between 25 and 28 though? No. 3%. Very good. Gold star for Larry. Much bigger difference between, say, a 15 and a 25, or 25 and a 35. And these are today's tax rates. So anyway, federal and state taxes of 18% on after-tax investment income, based on a 15% capital gain rate and unqualified dividend rules. Now, think of it this way: for any taxable account, for any non-retirement account, there is going to be some tax drag. You can have a municipal bond which is tax-free, but you're also going to be giving up a lot of return if you own municipal bonds. So there is going to be some tax drag. You're going to get those 1099s every year for any dividends, qualified or non-qualified, capital gains, any interest, so on and so forth. Don't worry, just know that there's going to be a tax drag. That's all I want you to take away from this. And that's what that bullet point is saying. Let's think of an 8% gross rate of return. So 8% total return, not after inflation, but it's 8% total. We're going to take only the minimum required distributions and reinvest those into after-tax funds. So this is basically saying, and one thing I would encourage all of you to think about, your own family, and if your folks have IRAs essentially that they don't need, but they have to take these required distributions, and then they just reinvest them or put them in the bank or whatever. This is really what we're talking about. So you don't need the money for income purposes in this first example. We'll show another example where you do, but this first example, we're saying you don't.